Hi everyone, welcome to the session. In this session, I'm going to discuss about the difference between change in accounting policies and change in accounting estimates. Basically, the difference between accounting policies and accounting estimates. So this is relating to IAS 8, International Accounting Standard 8, changes in accounting policies, change in accounting estimates, and correction of errors. So relating to this standard, I'm going to summarize the difference between accounting policies and accounting estimate by taking a practical scenario or practical example. Okay, so let's dive into the session. Uh, Accounting policies provide the framework for preparing and presenting financial statements. They ensure consistency and comparability of financial information across different periods and entities. Okay, so basically, the accounting policies will provide you some guidance or the framework as to how you should prepare the financial statement and how you should present the financial statement. They ensure consistency and comparability. So once you apply the policies, it has to be presented consistently in order to compare the financial statement from one year to another year. Okay, so that the readers of the financial statement can understand the financial information accurately. So imagine you're building a delicious pizza. Okay, so this is the practical scenario I'm just going to talk to you. I'm going to talk to you about. Accounting policies are like the recipe you follow to make sure every pizza is just right. Okay, so when you take a pizza, there is a recipe. So something like that, if you take the accounting policies, so that will be the recipe for the company. Okay, so that will provide you the guidance for the company. When you look at the framework for preparation, just like a recipe guides you through making a pizza step by step, accounting policies are the rules that guide companies in preparing their financial statements. So basically, the accounting policies. So when you take the recipe for a pizza, so we have the accounting policies uh, that that will provide you guidance for the companies to prepare their financial statement. So these statements are like a snapshot of company's financial health because we prepare the financial statement that consists of income statement, the balance sheet, and the cash flow statements. Okay, so from that we can understand how the company is performing. Then the consistency and comparability. Think about this way. If you visit different pizza places and each one makes their pizza in a completely different way, so you won't know which one you like the most. Okay, for example, let's say you go to different pizza places and they make different pizzas, so there's no consistency. Okay, so you will not know which one you like the most. Okay, so similarly, the accounting policies help companies make their financial statements in a consistent way. So this will help us to compare the financial performance of different companies and see who's doing well and who needs some extra cheese. Okay, so therefore the consistency and the comparability is the key when you present the financial statements. Okay, then across time and entities, just like you might make pizza today, tomorrow, and next year using the same recipe, the companies use the same accounting policies over time. Okay, so when you apply the accounting policies, it has to be applied consistently, as I told you, for the comparability reason, so that the readers can understand the financial statement accurately. So this will help us to see how they are doing year after year. Plus, it's like speaking the same language. Everyone understands the numbers no matter when they are looking at the financial statements. So this is very, very important. When you read the financial statement, you should be able to understand the numbers. Okay, so helping us understand, just as a well-written recipe helps you create a delicious pizza, clear accounting policies will help companies show their financial story in an understandable way. Okay, it's like explaining what's in your pizza in a way that makes sense to everyone. Okay, so when you apply the policies consistently, so you can easily compare from year to year so that the readers can understand the financial statement. So accounting policies are like the secret ingredients. Accounting policies are the secret ingredients that make financial statements consistent, comparable, and understandable. Okay, so these three features should be in the financial statement. Okay, so accounting policies are like the secret ingredients that make financial statements consistent, comparable, and understandable for everyone. Just like a recipe makes sure every pizza is as tasty as the last. Okay, so this is basically the accounting policies. Now let's move on to the accounting estimates. A change in accounting estimates arises due to new information or developments and involves revising estimates of the effects of past or future transactions. Okay, so these changes are applied prospectively, which means we don't go and adjust the previous year financial statement if there is an accounting estimates. So just picture this scenario. You are planning a road trip to a new destination. Think of accounting estimates like your GPS guiding you on the journey. Okay, so just assume, think your what you call the accounting estimates like your GPS. Okay, so here how it works: new information and developments. Imagine you are driving and suddenly your GPS notifies you about a road closure. Okay, so when you drive, you have the GPS and it notifies you about a road closure. That's like new information coming your way, right? It's a new information to you. In accounting also, the companies get new information or things change, like how much an asset is worth, how much a customer might not pay. So these are new changes to the information. So you need to act accordingly. So you need to revise your estimates. Okay, so just like you adjust your route based on the road closure, so what you have to do as a companies adjust their financial estimates based on new information. Okay, you are getting some new information. Based on that, you need to act accordingly. They might need to estimate how much an old machine is still worth or how many customers might not pay their bills. Okay, so you want to change the what you call the useful life of the asset, or else you need to change the accounts receivable based on the what you call whether the customer might pay or not. These are predictions, but sometimes they need to change when new information pops up. Okay, so based on these new changes, you may have to revise the financial statement and you need to act accordingly. Past and future. Let's say you had planned to grab lunch at a certain time, but due to the detour, you will reach later. Okay, in accounting, changes in estimates after estimate affect both past and future numbers. Okay, so it's like saying, hey, in the past we thought this machine would last for 10 years, but now it's looking more like 12 years. So you update the numbers accordingly. Okay, as I told you, we need to act accordingly based on the new information, new changes to the financials. Okay, so therefore, when there is a change in the information or change in the any development to the financial statements, so what you need to do is you need to apply it prospectively. So just as you take the detour and keep driving, this is very important. Okay, you took the detour and you keep driving. Okay, so companies apply these changes going forward. So if there is a change in the estimate, so you need to change going forward, so which means prospectively you need to change the financial statements, so which means the current financial statement has to be updated. You don't need to go back and change your previous financial statement. They don't need to go back and change past financial statement. It's about adjusting their financial map from now onwards. So in a nutshell, change in accounting estimates are like recalculating your road trip plans when you find out about a detour, new information, new developments. It's about adjusting financial estimate based on new information, driving smoothly into the future. So this is the basic what you call the difference between the accounting policies and accounting estimates. So let me give you the summary. I have summarized this in terms of aspects: change in accounting policies and change in accounting estimates under these three headings. And first of all, the definition. What is the definition? A change in accounting policy involves adopting a new accounting treatment for a specific type of transaction, event, or item. So change in accounting policies means you are going to change the policy or the framework or the guideline. Okay. Change in accounting estimates. A change in accounting estimates involves revising the estimation of the effect of past or future transaction due to new information or new developments. Okay, you are going to change the estimate. So what is the nature? It's a change in how transactions or events are recognized, measured, and presented in financial statement. If you want to change the policies, change the framework, so that will affect the transactions and the events. Okay, how it should be recognized, measured, and presented in the financial statements. Here the accounting estimate is a revision of the monetary amounts recognized in prior periods, but it does not involve changing the underlying accounting policy. Okay, so as a result of change in accounting estimates, it does not mean there is a change in the accounting policy. So therefore we can adjust it accordingly in the current financial statements. Retrospective application. Usually the change in accounting policy applied retrospectively, meaning prior period financial statements are restated unless impracticable. Okay, so we need to we have to change the prior period financial statement if there is a change in the accounting policy or the framework. As far as the accounting estimates are concerned, which is applied prospectively, meaning changes affect current and future period without adjusting prior periods. The material changes usually require restatement of prior periods. Material changes are reflected in the current period only. So what are the disclosure requirements? Disclose the nature of the changes, the reason for the change, the transitional period provisions, and the impact on the financial statement. So these will have to be disclosed. Disclose the nature, amount of the change, if practical, and that it's impractical to do so. The reasons for the change include impact in the current period. So for example, changing from FIFO to the weighted average cost for inventory valuation. Okay, so when you change from FIFO to weighted average valuation, it's a policy change. Okay, so this has to be adjusted retrospectively. Okay, adjusting the provision for doubtful debts due to change in customer payment pattern. So changing the useful life estimate for an asset based on new information. So these are change in the current estimates. So as a result of that, it has to be adjusted in the current financial statement, or it has to be adjusted prospectively. So these are the main difference between changes in accounting policies and change in accounting estimates. Okay. So with that, I will conclude the session. I will see you soon with another video. So thanks for watching, and bye for now.